Assalamualaikum everyone. Today we will dive into an in-depth exploration of Aeon financial performance, uncovering key trends and insights that highlight the company's current standing in the industry. Aeon Mall integrates retail, entertainment, and community spaces, generating revenue from consumer goods and mall rentals. Guided by customer-first value and sustainability, Aeon reported RM 4.1 billion in revenue for 2023 with a market cap of RM 2.2 billion in 2024. It operates over 35 stores, 28 malls, and specialty outlets nationwide. Ratios are essential for evaluating performance, guiding decisions, and building investors' confidence. They measure key metrics like profitability and efficiency, help managers address issues like declining ROI, and provide investors with valuation insights through price-to-earning ratio. Now we move on to the historical analysis. Let's begin with the first ratio, which is liquidity ratio. Liquidity ratio shows how easily a company can convert assets to meet debts. A higher ratio indicates a better ability to avoid payment defaults. For the quick ratio, we got 0.13 times for 2023 and 0.17 times for 2022. The quick ratio declines from 0.17 times in 2022 to 0.13 times in 2023, suggesting a reduced capacity for the company to meet its short-term obligation using the most liquid assets. For the current ratio, we got 0.51 times in 2023. Meanwhile, in 2022, we got 0.50 times. The Aeon current ratio has slightly improved from 0.50 times in 2022 to 0.51 times in 2023. However, both values are below 1.0, suggesting that Aeon might face challenges in meeting its short-term obligations with its current assets. Now we move on to the debt ratio. The debt ratio or debt to asset ratio measures a leverage by dividing total debt by total assets, showing how much debt a company holds relative to its assets.
Next, Aeon debt ratio. Aeon debt ratio measures its reliance on debt financing. From 2022 to 2023, the debt ratio decreased from 67 to 64. This drop signifies a reduction in Aeon's reliance on debt, as a proportion of asset financed by debt has declined. By maintaining this trend, Aeon demonstrates its effort to strengthen its financial stability and minimize risks associated with high leverage. Now, I'm going to move further on the time interest ratio, or TIE, that measures the company's ability to meet its debt obligation using its current income. A consistent ratio of 2.84 for both 2022 and 2023 highlights financial stability. This consistency reflects a steady capacity to cover interest expenses, ensuring the company remains solvent and dependable to creditors. Next, asset management ratio. Asset management ratio evaluates how efficiently the company utilizes its resources to generate revenue. This includes inventory turnover, the average collection period, and total asset turnover. By analyzing these ratios, we can determine how well the company maximizes its resources, manage cash flow, and maintain operational efficiency. The inventory turnover ratio of Aeon has increased from 4.0 in 2022 to 4.31 in 2023. This improvement indicates better inventory management, with the company selling inventory more frequently. Higher turnover reduces the risk of excess stock while maximizing revenue, reflecting more effective operational strategies. Meanwhile, the average collection period rose from 6.80 days in 2022 to 7.87 days in 2023. This suggests that it took longer for the company to collect payment from customers. While a longer collection period could impact cash flow, it might also be a strategic move to attract or retain clients by offering extended payment terms. The total asset turnover ratio also increased from 0.76 in 2022 to 0.79 in 2023. This improvement shows that the company has become more efficient in using its asset to generate revenue. Higher turnover indicates stronger operational performance and better utilization of resources, positively impacting overall profitability. Now, we are going to talk about the background on profitability ratio. Profitability ratio are key indicators of how well a company turn their resources into earnings. These include their gross profit margin, net profit margin, return on asset, and return on equity. They help evaluate operational efficiency and financial health, providing insight into how effectively the company generates profit relative to its resources and investment.
The operating profit margin measures the percentage of profit Aeon generates from its operation before deducting interest and taxes. It is calculated as EBIT divided by sales. In 2022, Aeon recorded an operating profit margin of 8%. However, in 2023, this figure decreased slightly to 7%, indicating a minor decline in operational profitability. This suggests that despite steady sales, the company faced increased operational costs or other pressures during this period. Next, let's look at Aeon's net profit margin, which represents the percentage of revenue retained as net income after covering all costs including taxes and interest. For both 2022 and 2023, the net profit margin remained consistent at 3%. This stability indicates that Aeon has managed to maintain its profitability levels despite the slight dip in operational margin. And then we analyze the return on asset, or ROA, which indicates how efficiently Aeon utilizes its total asset to generate profit. In both 2022-2023, Aeon maintained an ROA of 2%. This consistency highlights the company's ability to sustain profitability relative to its asset base over this year.
Next, let's take a look at Aeon's returns on equity or ROE. ROE is a key financial metric that measures how efficiently a company uses shareholders' equity to generate profit. It's calculated by dividing net income by total equity, as shown in the formula here. For Aeon, the ROE remained consistent at 6% in both 2023 and 2022. This stability shows that Aeon has maintained a steady level of profitability relative to the equity invested by its shareholders. It highlights Aeon's ability to efficiently manage its resources and deliver reliable returns, reflecting positively on the company's financial health and operational performance. In conclusion, Aeon Malaysia demonstrates financial stability with a low debt ratio and strong return on equity. However, it faces challenges in liquidity cost control and inventory management. To improve, the company should enhance liquidity, optimize inventory processes, and focus on high-margin products to boost profitability and long-term growth. As we conclude this presentation, allow me to speak on behalf of Aeon Malaysia. First and foremost, Aeon Malaysia takes pride in being a trusted name in the retail industry. With over 35 stores and 28 malls nationwide, we strive to create a holistic shopping experience that integrates retail entertainment and community engagement. Our commitment to sustainability and customer-first service has solidified our reputation as a leader in the industry. While our achievements are significant, we are always looking for ways to improve. I'd like to propose 4 key recommendations to strengthen our performance further. The first one is enhanced liquidity. We aim to optimize expenses and renegotiate supplier terms to ensure better management of our short-term obligation. The second one is boost inventory turnover. By refining stock management practices and conducting precise demand analysis, we can minimize inefficiencies and maximize operational efficiency. The third one is improve profit margins. A focused strategy on high-margin product and tighter cost controls will enable us to deliver better returns. And the last one, leverage low debt ratio. With our financial stability, we are well positioned to explore strategic investment that drive growth and innovation. At Eon, we believe in continuous improvement and innovation to meet the ever-changing needs of our customers. With this step, we are confident in achieving sustainable growth while maintaining our position as a market leader. Thank you for your time and attention, and we look forward to your continued support as we move toward a brighter future.